Okay, good evening, everyone. I guess we can start our class now. Can anyone confirm that you can hear me before I proceed?
Good evening, sir.
I hear you, sir. Good evening, sir.
Okay, all right. So, good evening once again. So, today we are going to continue on group account. Specifically, we're going to look at business combination achieved in stages or piecemeal acquisition. If you remember, when we started group account, I started with revisions on the cancellation rule when you want to consolidate a parent and a subsidiary account. All we're simply doing there was just to cancel out the similar transactions between the parent and the subsidiary, especially transactions relating to investment in the subsidiary in the books of the parent that is cancelled out against the um, share capital and the pre-acquisition reserves of the subsidiary, representing what the parent has acquired. We believe those two are similar transactions and they should be cancelled out. There are other similar transactions that can also arise as a result of intra-group trading, like if they sell goods to one another and they are owing one another, such receivables and payables should be cancelled out. Or if they sell goods to one another and they are making profit from one another, such profit should be cancelled out on consolidation. So, see, those cancellation rule applies where the investment is an investment in subsidiary. However, where the investment is an investment in associates, we looked at that last class, where you have holding in another entity and your holding is between 20% but less than 50%. We said that's an investment in associate. And we saw that such investments would be accounted for using equity method. And yes, we haven't finished that solution on equity method. So we're going to be finishing it because we're doing it together with the other guys. So we're going to finish that solution together with them. So I'll just continue from our own side of consolidated account. But majorly, what we learned in associates is the fact that we use equity method for consolidation. And when you use equity method, all you're doing in a consolidated account is that you are going to be increasing the cost of your investments with the parent share in the associate's profit. So every year, you're going to be increasing the cost of your investment every year. And that is in the consolidated account. And I told you that it's possible that the associate makes losses. When you have such scenario, yes, that means the losses will be diminishing your investment. But when you get to a point where the losses makes your investment to turn negative, that means you need to stop incorporating that investment in your books when it is at exactly zero. You stop consolidating it. But don't forget that the parent is also a company. Yes, it prepares consolidated account. But don't forget that he would also prepare his own account, his own separate account. So in his own separate account, all he puts in his books is just the cost of investment. Always try to distinguish between the two. That in the parent's account, It's just the cost of his investment that he put in his books. It doesn't increase that cost to its share of profit. No, that is only done in a consolidated account. So we explain other details, which I would also revise soon. Now, why I actually went through that is because we are going to need knowledge of associates today and some other knowledge, especially for statement of profit or loss. But let's commence and see if you guys would have the ability to actually follow through. Within the next maybe 1 hour, we should be able to resolve it. And I need to also mention that we moved to complex group. And basically, I focused on sub-subsidiary. And it's substantially the same as simple consolidation. The only difference is when it comes to sub-subsidiary, that means the parent has both direct interest and indirect interest in a sub-subsidiary. He has a subsidiary, that subsidiary acquires another subsidiary. So indirectly, the parent will be having holding there. So the key to be successful in consolidating this sub-subsidiary, because to consolidate your own subsidiary is straightforward, it's just the normal way. But the parent would also have interest in this sub-subsidiary, both directly and indirectly, depending on how the question is structured. So we need to identify the parent's effective holding in the sub-subsidiary, and that would be the basis for consolidation. And in canceling out, this wasn't the problem for us in the last class. It was the parents in SS group. The direct acquisition he has and the indirect. Now, the indirect is through his subsidiary. So this 60% of 21,000 we did was 60% of the amount paid by his own subsidiary. That becomes his own payment. And the area of confusion that a lot of you focused on was this NCI. That, why is this one 40%? Why not? And I try to explain to you that the essence of this NCI is not to balance up with this, but rather it's just to be there, just to compare 100% with 100%. So in this case, you might not obviously see the 100% because of this is a complex group. This is an acquisition through a subsidiary, while this one is also a combination of the two. You might not see it directly. But ultimately, you now not to confuse yourself. If you decide to even remove this entirely, you just compare this consideration transfer directly against the parent share, the parent effective holding in this 32,005, you get exactly what you're looking for, which is this 69. So we need to then focus on the fact that this one is just in and out. So this 44% is our effective holding in SSCO, which is this 44%, which would automatically cancel out with 44% of this. So it's in and out. It doesn't really affect anything. And that was really the highlight of the last class. Now, today, we are looking at a scenario where there is a business combination achieved in stages. You see, this is where the parent acquires its holding in the investee in stages. Now, the key stages for us, the key stages for consideration here is where the acquisition results in a controlling interest. This is where you might find in the exam. So, for example, where a parent has 20% holding in the subsidiary and acquires further 40% holding after 2 years. So this additional acquisition gives the parents control over the subsidiary or over the investee. Let me call this one investee because it's not a subsidiary yet. So this is the first key stage. Now, the key stages for consideration here are, number one, is where the acquisition results in a controlling interest. For example, where a parent has 20% holding in the investee, and acquires further 40% holding after 2 years. This additional acquisition gives the parent control over the investee. Then how do we then account for that? Obviously, that means at the point the parent gets control, he will need to consolidate. He can then prepare consolidated accounts because now he has control. And of course, the second one is where the acquisition results in increase in controlling interest. It only results in increase in controlling interest. So, for example, where a parent has 60% holding now in a subsidiary and acquires further 20% holding after 2 years. Okay, so this additional acquisition, it doesn't give the parent more control. It doesn't give the parent more control. What this additional acquisition does is that it actually reduces the holding of the NCI. So you need to understand these two statements very well because that's really the idea. When we say business combination achieved in stages, it's actually these two that would occur. Number one is where a parent has 20% holding and then acquire 40%, additional 40. So you see that he now has control because he has crossed the 50% boundary for controlling interest. The second one is that there was only an increase in controlling interest. You already have control, but now you have increased it by 20%. The impact of that is that is only reducing the holding of the NCI. Okay, so this is similar to transactions among owners. It's like shareholders are transacting, it's transaction among owners, between owners of the company. Okay, so in the first scenario, where the parent obtains control from piecemeal acquisition, the parent must therefore prepare a consolidated financial statement. And when we want to do that, the first thing it does is this, before you do the cancellation, when we say consolidated financial statement, meaning that we need to do cancellation, any similar transactions, we cancel it out. Now, the first thing it needs to do is that the previously held investments, held investments in the separate account of the parent must be derecognized. When I say derecognized, it means that, let's say it was having 20% before. Now he has bought additional 40%. So we assume that now he has 60%. Now he has 60%. And it's important we know what is the value of that 60% today. So when I say derecognized, well, we won't, it is not derecognized in the literal face of it. It's just the fact that the value he bought it that time is not what it will be today. So his books in his separate account, he will need to, that 20% you will not find it there. What you'll be finding there now is 60%. Right? What we find there is 60%. So in the separate parents, it's in the separate account of the parents must be recognized. And this will result in a profit or loss on the recognition. And this is calculated as below. Number one is the fair value of the previously held investments. Whatever it is, that is the value today, compared with the cost of the investment, the carrying amount of the investment. What's the carrying amount of it? How much did you buy it? And what's the book value today? So by the time you compare these two, it gives you profit or loss on the recognition. Now, that's the first thing we do. The second thing we do is we can then go ahead and do our normal cancellation that we have been doing. And our normal cancellation will result in what? Mostly goodwill. Mostly goodwill. And how do we get the goodwill? We get the goodwill by canceling out how much we paid against the net assets acquired. So how do we get that? We will determine the consideration transferred, how much we paid, That's for the new acquisition. You know that we have acquired additional. And don't forget, there was a fair value of previously held investments because this is in stages. It's not like we paid everything like today. We have invested some previously, we then acquired more. But that's more acquisition, that additional acquisition gave us control. So we need to do consolidation. Now, and you know, consolidation requires cancellation of similar transactions. So we will need to do this cancellation. And already in the books of the parents, you will have recognized the new acquisition. And don't forget, I told you that he would update, he would recognize the old investments and he will by getting the fair value. So he would have updated, he would have gotten the fair value of that previously held investment, which is going to find in the books of the parents in a separate account. So this would represent how much the worth of what he has paid, the worth of his investment as of today. And in line with how we do it, we usually bring in non-controlling interest, not for anything, but just so that we are comparing 100 with 100. Just so that when we do net asset acquire, at the end of the day, we won't be doing 80% of net asset acquire, something like that. So we bring in NCI. What's the value of NCI? And this value of NCI is at the date control is achieved. Don't forget, that is when NCI will only happen. If you don't have control, probably you might even be the NCI yourself. So whatever this gives you, this is the fair value of what we have paid the subsidiary. Then we then compare that with the net asset acquired. Net asset acquired at the date control is achieved. And this doesn't change. It's just the share capital of the subsidiary against all the pre-acquisition reserves. So this gives us what we need. Then we'll get our goodwill. So this is the major thing. Every other thing remains absolutely the same. I think this is the new thing you're learning. If you had actually been following us. So this is it, where you don't have control before, but you would add control in stages, meaning that you had a previously held investment before now. So the first thing I said that in the parent's account, you will need to recognize that his old investment and update it to the new one. In the process of that recognition, you will see that he might have made a profit or a loss. By the time he compares, okay, that investment that I bought before, what's the value today? Against how much I bought it. Or what's the book value today, depending on what type of investment you had before. Then it becomes profit or loss on the recognition. Let me speak a little more on this, the book value of that investment. You know that if it is an investment in financial assets, if it's just a financial asset investment, this would most likely be the cost of investment, mostly, and in all cases. But if it's an investment in associates, This might also it also be the cost of investment, because except if you want to take it in or adjust it in the consolidated account, but this is in the separate account of the parent. So it doesn't matter what type of investment is carrying, it's probably going to be the cost, or probably if the carrying amount is measured at fair value through POL or OCI, but then whatever it is that is the book value at the date when you are fair valuing it would be the carrying amount here. Then we then go ahead with your normal calculations. Now, this is in the first scenario. In the second scenario, where the parents increases its controlling interest, where the parent increases its controlling interest. Here, the only adjustment required is an adjustment to the equity of the group. And this is because there is a reallocation of ownership interests between the parent and the NCI. There's a reallocation. Just like I had 60% before, I now acquired additional 20. What happened there is I only took 20 from NCI because NCI was 40% before, but now NCI will now be, since I've bought 20, they will now remain 20. So what we need to adjust here in the group account, so in the consolidated account, you need to make adjustments to the parent equity as follows. We are going to compare the fair value of consideration transferred for the new acquisition we are going to compare that with the decrease in NCI, because your NCI will have decreased. Whatever the difference will result in also a profit or loss, or which we popularly call adjustments to parents' equity, which are going to take to POL, whatever it is that is difference. Now, and that's all for this topic. That is really all. That's everything. So let me recap before we solve questions so you can follow. Probably you might want to ask questions before we start solving. Again, we're looking at a scenario where a parent gets control in stages. He didn't just get the control once, but it was in stages. So it's two things, eh? Number one is that he crossed the 50% boundary. He was not having control before. He was either having a financial asset before, or an associate investment before, then he gets control. That's the first one. So, and the second one is he only increases control. Is controlling interest. We said the implication of this first one is that he then now needs to consolidate in the that means he will do cancellation and all that, and he will start getting a share of post-acquisition profit of that subsidiary. Just the normal way we consolidate subsidiary, will start consolidation. However, additionally, the parent might also have made a gain in his own account because now that he has acquired more, we would then have the opportunity to know, okay, what was even the value of that investment I've bought many years ago? What's the value today? So, and that's why in the parent account, he might have either made a profit or loss on investment. So we treat it as if we are recognizing that previously acquired investment because you won't find it in our books anyway, again. And that's why this profit and loss of investment is coming up. But you need to be very careful here, right? This profit or loss on investment, you take it to P&L, all things being equal. However, I was mentioning something that if this previously held investment was classified and measured at fair value through OCI, that means whatever profit or loss you get here, you have to take it to OCI. So you need to watch out and understand it very well. But all this is happening in the separate account of the parent. Of course, it will end up in the consolidated account as well. However, it does its normal cancellation, but the process of this one is quite different because of the introduction of this line, fair value of the previously held investment, which we compare to the net asset acquired at the date control is achieved. In the second scenario, very straightforward. The only thing that changes, because it's not like you are just achieving control. You have had control, you have been consolidating. So it's not like you want to then now start computing goodwill. Goodwill is computed at the date of acquisition. So you will have computed that long ago. So all we need to do now is just to adjust for parent equity because ownership is changing hands. Some people might be making profits, some might be making losses. So as far as the group is concerned, there is a reallocation of ownership interest. And we need to compare how much we are paying compared to the decrease in NCI, which is equivalent to how much somebody is giving up because we are all members of the group. Then there might be a profit or loss on so that everything would actually balance up here. So, and that's majorly all we need to do at this level. Now, let's look at some questions to practice this. This is looking at Raj. It says he has a subsidiary Meg. Yeah, Ufoma, can you ask a question? I didn't get you.
Hello, sir.
Yeah. Yeah, I'm with you, Ufoma.
I'm asking, how can you account for? Can you hear me, sir?
Yes, please.
Hello? I
Yes,
said,
I
how
can hear you.
can you account for? How can you account for transaction that took place between the two owners before control is achieved?
Okay, so for a very good question, Ufoma. I really like that. So for those ones, no issue because they were not really owners of the subsidiary. There was the issue of consolidation didn't arise. It's just like you bought at that level, it's just like I bought shares in, let's say, First Bank. I bought shares in First Bank and now bought additional shares again. You just all you need to do is just to keep increasing your financial assets. No, nothing special at that level. Nothing special at all. So why this is a case is because where it becomes special is where you then, that your piecemeal acquisition then gives you control. So when it gives you control, that is when you now, all your previously held investments then now becomes controlling interest. So in your separate account first, you would remove that previously held investment and update it to a new one. When you're recognizing it, that's where I was talking about profit or loss on the recognition before you then prepare consolidated account. That's why this is coming up, because now you have achieved control. But before you achieve control, you are now doing piecemeal. Just be increasing the cost. If your financial asset before was 20 naira, then you now bought additional 15 naira investments. Hey, that means in your books it becomes 17 naira. That's all. Like that. So that's outside the scope of this one. That's just normal investments that we do. This one is when control is achieved in stages. So is either when you cross from maybe financial asset or associate investment, you cross to control. That's what we are looking at. Or where you have control before, you now increase your controlling interest. That's the second one. That is where this applies. I hope that's clear. Okay.
Okay, sir. Yeah.
You're welcome. So when looking at Raj, see, he has a subsidiary MEG, which is acquired in stages. The details of the acquisition are as follows. On January 1st, 2014, he had 20%. At that date, the retained earnings of the subsidiary, which is MEG, was 540, and he purchased it for 240. On 1st January 2015, he acquired further 50%. The retained earnings of the subsidiary was 900. He paid 960. We're now told that the share capital of MEG has remained the same since incorporation as 600 million. And the fair values of the net asset of MEG were the same as the carrying amount at the date of acquisition. Raj did not have significant influence over MEG at any time before gaining control of MEG. The group policy is to measure NCI at proportional share of the fair value of the subsidiary's identifiable net assets. We're now required to calculate goodwill on the acquisition of MEG that will appear in the consolidated statement of financial position. We're also required to calculate profit on the recognition of any previously held equity investments. Okay, so this is the typical first scenario that I gave you, where we didn't have control before. We now now we have control, right? Because altogether now, Raj has 70%. And also, within this question, there are some things that we need to note. Number one is this. They said the fair value of the net asset of MEG were the same as their carrying amount at the date of acquisition, meaning that it's possible that they are not the same. It's possible that they might not be the same, that the fair value of net asset of the subsidiary is not the same as the book value. If they are not the same, that means there might be a fair value adjustment. I don't know if you still remember that, which becomes like a reserve, because that's like we treat it as an increase in the asset of the subsidiary. So debit asset with credit reserve, and we're going to treat that reserve as a pre-acquisition reserve. But in this case, they are the same. Also, they say Raj did not have significant influence over MEG at any time before gaining control. So that shows that even though this is 20%, they are saying it's not an associate investment. So don't bother thinking maybe he might probably have been sharing profits of MEG before now. No, they said this is a simple investment or a financial asset. It's never a significant influence. It never had significant influence over MEG. And we are told that NCI is measured at proportionate share. Okay, you need to be very watchful of this as well, because it's either NCI is measured at fair value or NCI is measured at proportionate share. In this case, it's proportionate. Okay, so how do we address this? We are asked to calculate goodwill. Like I've shown you already, we would look at the consideration transferred, which is this case is the additional 50% holding. For the 50%, he paid how much? Paid 960 million. Paid 960 million. And also, we're also going to determine fair value of previously held investments. And also, we're going to determine the non-controlling interest. So we need to determine these three. So how do we determine the fair value of this 20%? Who can spot out the fair value of this 20% here? Let me just allow you 5 seconds to see if you can sort that out. Anyone?
Sir, hello, sir.
Yeah, Michael.
Yeah, I think the fair value of the previously held investments is 240,000, sir. I mean, sorry, 240 million, sir. Because it is it is the purchase consideration at the 1st of January 2014, sir.
Okay, good. So that's the historical cost of this 20%. This is how much he paid in 2014. But what I want to know is what's the value of this 20% today, which is 1st January 2015, when we acquired, now that we have control. Because that's what we need. We need the value of this 20% today.
So, sir, is it like we will now discount? We'll use annuity factor?
Discount what? Did they give us future value that want to discount to present value?
So can I try?
Yes, I can try. Yes, you
Will it
can
be
try.
20% of 960 of the purchase consideration in 2015?
20% of 960. That's very, very logical. That's very logical. But you're close, but you're not there. Because this 960, if you are doing 20% of 960, you are doing it as if this 960 is 100%. Whereas this 960 is not 100%. So you cannot do 20 per 100 times 960.
Sir, can I try?
Yes, please.
Sir, can I try? Okay, so I'm going to do 40% of 960, which is 384,000, sir. Sorry, 384 million, sir.
Where is the 40% coming from?
Okay, what I did was I did 20 over 50, which is the 20% over 50%, which gave me 40%. Then I multiplied it by 960, which gave me 384 million, sir.
That's correct. That's correct. So that's correct. So the 40% was not even necessary. rather than the fact that I've forgotten your name, Tintin. Remind me your name. You
And
said,
Chinesa.
okay, Chineke. So the other lady that spoke first. So what's your name?
Eno.
I know, yeah, okay. So you said that this is 20% of 960. So you're only wrong because you are saying this 960 as 100%. But now she came in and said that, Chineke came in and said that this 960 is the worth of 50%. This 960 is just 50%. So if this 960 is 50%, then what is 20%? 20% is just 20 over 50 times 960. That's 20%. So Chineye was absolutely correct. 384, and that's absolutely intelligent. So if the value, you say, I needed the value of this 20% today for my working, so I can know that, okay, this is the updated value of my previously held investment. So since I paid 960 for 50%, then from there I can determine the value of 20%. I can determine value of 20%. It's just 20 over 50 times 960. However, a more let me say visible way of doing it is if they had given me the share price of the subsidiary of Meg, if they are giving me his share price as at 1st of January 2015, they are giving me his fair value today, his share price today, I can as well use that to determine the fair value. So I will just do 20% times the number of shares in the subsidiary. That will give me the total number of shares. Assuming this 600 million is translating share, this 100 million share capital is 600 million shares. I'll do 20% of 600 million shares. I will then multiply it by the share price of the subsidiary. That would give us almost the same thing if this is 50% was computed based on the share price as well. But I don't have that information here, so I cannot go that route. So I have to go through the route of 20 over 50 times 960. And that's how we're determining this. Now, similarly, how do we get NCI? You see, which is why this becomes important. They said NCI is measured at its proportionate share of the net asset of the subsidiary. That means before we get this, because NCI is now 30%, that means we will need to get the net assets acquired of the subsidiary, which is the share capital of the subsidiary. How much is the share capital of the subsidiary? 600 million. 600 million. And the pre-acquisition retained earnings. So at the date we had control, what was the retained earnings of the subsidiary? It is now 900, not this. At this date, we never had control. So what we want is the retained earnings of the subsidiary as at the date we had controlling interest, which is this date, 4 January 2015. And as at that date, the retained earnings of the subsidiary was 900 million. So 900 million. So together would have 1.5 million. So with this now, since NCI is measured at proportionate share, it's just 30% of 1.5. How much does this give us?
450.
450. So let me ask you a question. What if the examiner had told us that NCI is measured at fair value, not proportionate share? They say it's measured at fair value. How would you have determined the value of this NCI?
It will be given, sir.
Let's assume we're not given.
Fair value of non-controlling interest is not only given.
It must be given. What if they don't
Yes.
give us?
If they don't give you to be on proportionate, sir.
You use the you use the share price of the company.
Exactly. You will use the share price of the subsidiary, right? You just do a 30% multiplied by your share capital, the subsidiary share capital, multiplied by the share price of that subsidiary. That's how you do it. So, Mr. Christopher, it's not every time. In fact, they might not give you. You must be able to determine it yourself. If they tell you NCI is measured at fair value. Let's assume that we don't have the share price of the subsidiary. Like in this question now, how would you have determined the NCI value if it was measured at fair value?
We use that of the parents, the share price of the parents.
No, why would you use the share price of the parent? NCI has nothing to do with the parent. It's really it bought investment in the subsidiary. What do you mean by no? I mean, what you
We
mean
would
was
have used the 600 million, 30% of 600 million. Right?
no, that's still proportionate share now. That's like doing proportionate share. So that's far from it.
Sir, please let me try, sir.
Okay.
Yeah, sir, since 960 is 50%, then to get 100%, we multiply it by 2. Like, I'm just trying to explain it in a layman's idea, sir. You
Okay,
know,
thank you.
we multiply it by 2. That is 960 by 2. Okay, I will now look for the 30% of that, sir. So to get the NCI, sir.
No, that's wrong. Why are you multiplying it by 2? That already distorts. Mathematics, that's already an unbalanced equation already. You multiply 1 by 2. Where is the other leg? To balance out. So I thought you were going to say 30 over 50 times 960. Just the same way we got this 20% here. The previously held investments, that was 20%. We said, okay, since we bought 50% for 960, and then from there we can know what 20% is. Then we said 20 over 150 times 960. And the same way you can get this one too now. So since value of 50% is 960 today, then today, the market value of 30% today should be 30 over 50 times 960.
Sir, hello, sir.
Yes,
Sir.
Michael.
Yeah, what I said, my illustration, I got the same answer. Sir.
Okay, here, Kajo. So let's check it. You said
I
you
said,
multiply 960 by 2, Abby?
no, sir, fine, yes, sir. I said I will multiply 960 by 2. Since this 960 is 50%, I'll multiply it by 2. Then I'll now look for the 30%. That's what I said.
And now, so if I multiply 960 by 2, that is 1,920. Then I do 30% of that. That gives me 576.
576, yes, sir.
Okay. So if I do the same thing as 30 over 50 times 960, we get 576. Okay, you're correct though. So Michael was absolutely correct. Okay, so nice one, Michael.
Hello, sir.
Yes,
So
Toyin.
how did he get the? Why is he using 2? Because I think
we should know why he's using that. So his own illustration is very simple, but why is he using 2? Is it because he's 50% and he's trying to gross it back?
Don't follow that approach, you will not be correct, though. Because if it's not 50%, it becomes a problem.
That's a manipulated approach.
Yes, it becomes a problem. It was, in fact, it was just a coincidence that it was even correct. I'm surprised it was. So this is the mathematically correct way. Because that one, by the time, let's say this 960 was, let's say, 45%. So how would you now take it to 100%? And that becomes a challenge. So don't do that. So in this case now, the examiner didn't ask you that, but they can ask you. It can be that. So you need to know it. So here, NCI is measured at proportionate share. That is why we simply did 30% of 1.5. But if it was at fair value, and this is how the question comes, then you need to do it exactly the way you did this. So get ready for that as well. So I think this is a major thing here. What's the oh, so what's the addition of all this?
Yeah, 1794. 1794.
Minus this gives us what?
294.
294. And this is the major thing, really. So that's a goodwill. And they want us to calculate profit on the recognition of any previously held investments, which is the B. Profits on the recognition of previously held investments. So what's the fair value of previously held investments? What's the fair value of previously held investments? We got how much? We got 384 from Watkins 1. Then compare it with the carrying amount of previously held investments. And how much is that? We bought it
240.
for 240. Then what do we have?
144.
144. And that's all around this. Okay, so let me come back to this again, because this is the only thing that's actually technical here. So for this goodwill, we did how much we paid for the further investments, the fair value of the previously held investments. And the only way we could do that was to say that, okay, since this 960 is 50% value, then what is this 20%? Then yes, then what is 20%? We say we should do 20 over 50 times 960. So, and even with what Michael did and what somebody said, I can also interpret this as that we can gross this up. We can gross this up by 200%. We can gross this up 200%, then we then multiply it by 20. So if this was, let's say 40, it will still be 20. I mean, I think just follow this approach. It makes your life easy. And this one also, if this NCI was at fair value, we will have done the same thing, 30 over 50 times 960. But it will have been easier if they had given us the share price of the subsidiary. Then that would have been more straightforward. But if they don't, be ready for this. Then this one is usually straightforward. It's just the fair value minus the carrying amount, and it goes to PL of the parent.
Also,
Yeah, Mr. Christopher.
we're trying to tell us if the fair value of NCI is not given,
Yes.
either at proportionate nor at given as a figure. You said you are going to use the share price, the ordinary share, I mean, value of the ordinary share.
Yes, so you will get the number of shares you have in the subsidiary times the share price of the subsidiary at the date you're doing the fair valuation, at the date of consolidation
Acquisition.
or acquisition, as the case may be, at the date of acquisition.
Then you now use the percentage holding.
Yes. Yes.
Hello, sir. I think
Yeah.
alternative to what he did, I just did something now.
Okay.
The grossing back, I think if we can say that we want to gross our 960 back to 100%, we just say that 960 divided by 0.5, which is the 50%. So we are grossing it back to our 100%. So we
Yes.
just multiply by
20.
50%. So it is going to give us 384. That's I think the approach of grossing it back.
Yes, good. So if you understand it that way, then you use it to remember. But ultimately, this is what you are still going to do. So if this is, let's say, 45%, it will still be 20 over 45 times 960. So it's like you're grossing it to 100%, then times this. It's still the same thing. Okay, let's solve a more advanced one that requires us to, like, something exam related. So let's look at this question. This says that Mammon acquired 25% of Regis on 1st January 2014 for 1,010,000 and exercised significant influence over the financial and operating policy decision of Regis. The fair value of Regis identifiable assets and liabilities at that date was equivalent to their book value, and Regis reserves stood at 2,900,000. A further 35% equity interest in Regis was acquired on 30 September 2016 for 2,100,000, paying a premium over Regis market share price to achieve control. The fair value of Regis identifiable assets and liabilities at that date was 4,600,000, and Regis reserves stood at 3,900,000. At 30 September 2016, okay, Regis share price was 15. Okay. Given the statement of financial position of the two companies, also given a statement of profit or loss and other comprehensive income of the two companies. So the difference between the fair value of the identifiable assets and liabilities of Regis and their carrying amount relates to Regis brand. The brand were estimated to have an average remaining useful life of 5 years from 30 September 2016. Income and expenses are assumed to accrue evenly over the year. Common policy is to measure NCI at the date of acquisition at fair value. Good. See, Mr. Christopher now. They want to measure NCI at fair value and they did not give us the value of NCI. So, okay, so this is more like what you might find in the exam if they want to ask you a question on this alone. So key things here that I will just sort immediately is that Mammon used to have 25% before, and he bought it on January 2014 for this amount. And now they are telling us that this 25% though was actually gave Mammon significant influence over Regis, gave him significant influence. So the fair value of Regis identifiable assets and liabilities at that date was equivalent to their book value. And Regis reserve stood at 2.9 million, which is at this date, Regis reserves was 2.9 million. Then he went ahead to acquire additional for 35%. That means now he has 60%. So control is now achieved. And this he acquired on 30th September 2016 for 2.1 million. Paying a premium over Regis market share price to achieve control. The fair value of Regis identifiable assets and liabilities at that date was 4,600,000. And Regis reserves stood at this. So what I'm saying here is this. Mammon now has 60% of Regis from 30th September 2016. It now has 60% of Regis from 30th September 2016. Additionally, they give me the fair value of identifiable assets, liabilities of that subsidiary at this amount. And they also gave me the reserve of that subsidiary of this amount, all at these dates. And also at that date, when he achieved control, they told me that the share price of the subsidiary is 15 naira. Okay. I mean, these guys are driving at something. Now, fast forward to this additional information. They said the difference between fair value of the identifiable assets and the carrying amount of Regis relates to brand. So that goes to show that I need to be careful to ensure that I actually spot the difference they are talking about here that relates to brand. Because fine, I was given the fair value of the assets. That means I need to compare it with the carrying amount of the asset and liabilities of the subsidiary, then so that I can treat the difference as a brand. And that is, one leg will go in as pre-acquisition reserve, the other leg will go in as an intangible asset in the books of that subsidiary. They even told me that the brand has an average remaining life of 5 years from 30th September. Income and expenses are accruable over the year. Among policy is to measure NC at the date of acquisition. Then prepare consolidated accounts, P&L and statement of financial position as at 30th December 2016. So now, the issue here is this. We are consolidating as at December 2016. And we achieved control in September 2016. That means that as far as the statement of profit or loss is concerned, we can only consolidate for 3 months. As far as P&L is concerned, because P&L is different from statement of financial position. Statement of financial position is a position statement. So even though this guy only had control for 3 months, from October, November, December, because the year end is December, the consolidation date is December, he only got control in September. It's still going to consolidate fully. That's same of financial position is a position thing. But you see P&L, this profit, this revenue for the whole year, when I want to consolidate, I can only consolidate just 3 months of this. That's how P&L works. It is for the year. And that I need to be very careful about in this case. Okay. So let's sort it out. So the first thing I need to do is that I need to get my profit or loss on derecognition. I need to get my profit or loss on derecognition because now this 25% have become 60%. So this 25% is no more in Mammon's book. And let's get what the value is today as against this, or probably we can follow the route of what we had done earlier. Let's determine our goodwill first based on the previous question. So let's do the consideration transferred. What was the level of rounding? 7,000. So how much did we pay for 35%? How much did we pay for 35%? We paid 2.1 million. Is that correct? We paid 2.1 million. Then we'll compare this with, we add fair value of previously held investments, which is the 25%. Which is the 25%. So again, I'm coming back to you. How do we get this? How do we get the fair value of this 25%?
25 over 60 multiplied by 2,100.
No, that's wrong. This 2,100 is not 60%. It's 35%.
Oh, okay.
So do you want to try again?
Yeah, let me calculate.
So is that you do 25 over 35% times 2,1. What would that give you?
1,500.
Or alternatively, you can do 25% times the number of shares in the subsidiary, which is 400,000 shares, since the nominal value is €1. So 400,000 shares times the share price of the subsidiary. Did they give us? Yes, they gave us the share price of the subsidiary as 15 naira. So what would that give us?
Same 1,500.
Okay, so either one is just fine. Either one you use is okay in the exam. So you just need to understand that they are speaking to the same thing. Again, NCI too. So who can tell me what is NCI now as at this September 2016 when we are doing all this? When we got control. So that's 40%. And now they said NCI is measured at what?
Fair value.
So how do you get NCI at fair value?
40 times 400 times 15 naira.
Thank you. What would I give you?
2,400.
Who can tell me and what is another way with which you can get this to 4?
Uh,
40
40 over
40 over 35
times 2,1.
times 2,1.
Okay. Does it give you 2,4?
Yes, sir.
Good. So either way you choose, there's a way there. So what's the total of these three?
7,000. 7,000.
7,000. Then net asset acquired. What was the share
That's
capital?
6,000, sir.
6,000, sir.
Okay, 6,000. Thank you. What was the share capital of the subsidiary? It was 400. Share capital of the subsidiary is 400. What was the pre-acquisition retained earnings of the subsidiary? When we at the date that's 3.9 million. 3.9 million. Then I can see that they said the difference, because the addition of these two will give me the carrying amount of the subsidiary. But I was given, which is 4.3. But the question actually gave us the fair value of the net assets of the subsidiary as 4.6. And they also went ahead to tell us that the difference between that fair value and the carrying amount is the brand of this subsidiary. So this is the carrying amount, 4.3. They give us the fair value as 4.6. The difference, they said, is brand, and is 300. And it's 300. So note that this is like a balancing figure. This 300 is a balancing figure. So how much is the goodwill we are looking for? Is that not 1.4? Yeah, it's 1.4 now. Now, having determined my goodwill, I can now determine profits on the recognition of previously held investments, which is, what's the value of the previously held investment today? 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,0 – What's the value today? Which we got here. Got it up here, 1.5. What's the book value today? The book value of this 25% is how much did we buy it? We bought it for 1,010,000. Abi? 1,010,000. 1,010,000. So why I'm extending it here is this, They told me that this is, I have significant influence over this investment. It gave me significant influence. And don't forget that means this investment was an associate investment. For associate investments, the carrying amount, if you remember, is usually the cost plus your share in the post-acquisition profit of the subsidiary of the associate. In the post-acquisition profit of the associate. And this associate in question, what was his post-acquisition profit? I think I'll have to, in order to reduce, I'll have to leave this one for, let me work it out so that you see it clearly. Let me use consolidated retained earnings because I'll have that of Mammon, that's the parents, then the Regis. However, this Regis, he was my associate for good 9 months. As far as 2016 is concerned, in fact, not 2016 alone, from 2014 to September 2016, I had 25% of Regis. So Regis was my associate for all those periods. And as my associate, I will get a share of his profits. So I need to get that share. So I will do Regis at 25%. He really big, and now he's my subsidiary. Now I have 60%. He's only my subsidiary now for just 3 months. Just for 3 months now. So I need to separate them so that I know that as far as up to September is concerned, I get my 25%. And from October to December, I get my 60% share of his profit. So where are we starting from? As at today, or the date of consolidation, as at the correction, or date of the date it got control. What was the retained earnings of Mammon? Mammon in his books has 5.1 million. Regis, as at the date, Regis is 25%. Okay. What was the retained earnings as at that date?
2.9.
No, this is the pre-acquisition retained earnings. So this is not the date. This is not the last date. I need the last date. This is the first date. This is the pre. Because in fact, I need the reserve of Regis as at these dates. I need it as at September 2016. Because as far as that 25% is concerned, this was when it ended.
As 3950.
Okay, this 3950. So
Yes.
this 3950 is as at December.
We can't. We prorate.
Okay, you do 9/12 or what? If you do 9/12, this 3950 is not a 12-month profit. It's a profit from the beginning of Regis. It's a retained and it's a reserve. So proration will not work. I need the reserve of Regis as at September 2016. It seems Michael has gone to sleep. If not, he will have
Sir,
participated.
I'm here, sir. I'm here, sir.
Yeah, becoming too quiet. No one can see the reserve of Regis as at September.
It's 39.
That's correct. Thank you very much. It's 39. Good enough. That was when we acquired additional 35%, and they gave us the reserve as at that date. So which is 39. Okay? 39. No, now as at December, which is a position where we already had 60%, then that is December 3950. And why I'm doing all of this is that as far as this 25% is concerned, I'm only going to get a share of his profit up until September. That's why I needed the profit till September. And this one I only get from October to December. So I needed this. So just for you to see it clearly, what was the pre-acquisition retained earnings? So as at when I acquired this 25%, his reserve was actually 2.9 million. His reserve was 2.9 million. So by the time I take away this, then I can then get my posts from the date I acquired them till September, because this guy ended in September. So whatever he has made between those period is this 1 million, difference of 1 million. I have to get 25% of that. This guy that is 60% also, when it was 60%, his retained earnings was, when I acquired him, it was 3.9, which I acquired him in September. So the difference of 50 is the retained earnings he made between October and December. And that's the post acquisition retained earnings. This is 1 million and this is 50. So with this now, I can easily do this, my share of this 1,000 clearly now, which is, I can come back to this to do the carrying amount of my investments, or my previously held investments. I know that I bought it for 1,100,000, but I need to get my share of its profit. which is times this. So what does this give us? What does this give us? This 1,260.
Yes, sir. It's 1 to 60.
1 to 60.
So what's the difference? So this 240. And that will be a profit on the recognition. This is a profit on the recognition. So this profit on the recognition is in the books of Mammon of 240. And you will then get his group share of Regis at 25%, which is 25% times 1,000. How much is that? You get 250. And you also get Regis at 60%. You get 60% times 50. How much is that? That 30?
30.
30, okay. So what's the summation of all this?
Five, 620.
5,620. Finally, is non-controlling interests. What's the value of NCI? From what we did up here, that's 2,400. 2,400. And NCI will get a share of post-acquisition profits, which is 40% times 50. So what does that give us?
20.
Let's try it. So what's the addition of the two?
2,420.
2,420. Okay. Do you have any
So
question?
please, I have a question.
Okay.
So when Regos was at 25 from January to September, the Mamo got 25%. What is the corresponding? I was thinking that NSE was supposed to get something from that one, not just on the post acquisition. That's where I have a little bit of confusion.
Okay. When when Mammon had 25% in Regis, Abi?
Yes, sir.
There
From
was no
January to
NCI
September.
that time. There was no NCI that time. In fact, it was the NCI. So NCI only came in from September. In fact, from October, where we had 60%. NCI only came up from October when we had 60%. So, which is why the only person that got 25% was just this guy, this Mammon. He just got 25% of this 1,000, which is his own share of the post-acquisition earnings of that guy between these dates and September 2016. Yes, somebody just reminded us that what about the amortization of this brand? This brand that we got here. We almost forgot that. So amortization of our brand name. So the brand name is 300. What's the useful life of the brand name? It's 5
5
years.
years.
So that's divided by 5. Okay. And this 5 is from when? Starts from September 2016. So as far as this year is concerned, to just be times 9/12. So what would that give us?
$45.
45, which means that the carrying amount of the brand now is actually 300 minus 45. What does that give us?
255.
So 55. Sorry, 9/12. Okay. From September. That's September to December. That's October, November, December. That's 3 months.
3 months.
Yes. So that's how much?
$15.
Okay. So this 15.
285.
So this will be 285. That means here, as far as this guy is concerned, this Regis is concerned, we're supposed to put amortization of brand name of 15. So what we should be having is 35 here. And that's what this guy can share. Cannot share 50, can only share 35. So what's 60% of 35?
21.
21. So this would be like 5611, something like that.
5611.
Okay. And that will affect this guy too. What will you get?
$14,214.
2414. Okay. So that's that for everything. It's not like it's difficult, but I mean, just need to do few things to get it right. So for Mammon, consolidated statement of profit or loss for the year ended 31st December 2016. I get my revenue, which is 5,001 plus 2,000 plus I only consolidate for 3 months. I hope you understand this part. I can only consolidate for 3 months because I gained 60% control at the end of September. So I only had control for 3 months. So what does this give us?
5,600.
So the second is cost of sales and expenses, which is 45 plus 18. Cost of sales and expenses. For 5 plus 3/12 times 18. And don't let us forget that 15, that brand name. Don't let us forget this brand name. So how much does this give us?
4965.
19.
4965.
Okay. 4965. So what's my gross profits?
10,565.
No, you are deducting.
Sorry. 635.
635. Then that's the profit before tax. My income tax is 180 plus 40. So they say this one is profit before tax. It's this. Then don't let me forget. I usually also add my share of profit of associates. Share of profits. Profit for the year of associates. Which is that 25%. I will need a share of profit for 9 months. A share of profit for 9 months. And what was his profit for 9 months? What was his profit for the year? So the profit for the year of the subsidiary, since we are still going to take our share of income tax from him, so let's just take this 200. our share of profits of the associates. Let's see. This even is profit. We'll go for this 160. Should take his profit after tax. We always take profit after tax, if you remember. So if you do this, what do we get?
$30.
We'll get 30. Then income tax. Which is 180 plus 40. 180 plus the remaining 3/12 times 40. Does that give us?
190.
190. So what's the balance? So what's our profit for the year?
475.
475, Abi?
Yes, sir.
475. I think there was other comprehensive income. What was the other comprehensive income? We have gain on property revaluation, which is 120 plus 40. Gain on property revaluation, 120 plus what? Plus 40
40.
times 3/12. What would that give us?
130.
And also, we are going to get share of associates gain on property revaluation, which would be the 9 months we associates. We also get our share of that, of this 40. Of this 40, just the same way we got associate share of this 160. Is exactly how we're going to get also associate share of this 40, because we were associate for 9 months. So we need to have a share of that gain on property evaluation as well. So this 160, we got associate share 9/12. The same thing for this property evaluation, we get associate share 9/12. So what would that give us?
30.
How much?
30. 30.
Okay. So what's my total comprehensive income? Which is 475 plus 130 plus 30.
635.
That's 635. Now, because this is a consolidated P&L, we need to share this profit for the year. A profit for the year attributable to owners of parents and that attributable to NCI. So the one that is attributable to NCI is simply NCI is 40% multiplied by profit for the year of the subsidiary, which is 160 that we got here. You will get 40% of that. However, after we had this NCI, we made an adjustment to these profits for this amortization, additional amortization of 15. So that needs to be removed. And all of this, we only get a share for 3 months. We only get a share just for 3 months. So Farmer is reminding us what of the profit on disposal? Which profit on disposal? Or profit on the recognition of 240? Yeah. That's true. Can put it here because it's the profit of the parents. It's the profit of the parents. So we are supposed to consolidate it. So just add 240 to this. What does it give us? That's 715 or so.
Seven,
okay. And it increases this to what?
875.
Okay. Good. So again, these profits we shared between the parents and the NCI. NCI only has a share of the profit for the year of the subsidiary, which is 160. And remember, after acquisition, we adjusted this profit with additional depreciation of 15 for the year. So multiply by 3/12. So the profit on the recognition is profit of it was the parents that made that one. Okay, not the subsidiary. So it has nothing to do with this. Then you only get just 3 months share of that. Because NCI came in when we gained control at the end of September. So you only get a share of October, November, December, just 3 months profit. So if you do this, what does it give us? Okay, somebody wants to ask a question. So how much?
6.25.
56.
36.25. Sorry,
Okay,
I didn't factor 40%. No. Sorry, it's wrong. I didn't factor 40%. Sorry.
Mm-hmm.
14.5. 14.5.
Okay, I can see one hand raised up. Can you ask a question, please? And then you're asking he wants to ask a question.
Okay, sir, please don't be offended. It doesn't have anything to do with the question we are solving.
Oh, okay.
Hello? Okay,
Yes.
please, I want to know if the last question on investment in associates has been solved.
No, it hasn't.
Okay. So are you still going to solve it?
Yes.
Okay, so thank you.
You're welcome. So the owners of parents will get the balancing figure. And the balancing figure, because the total year is how much? $715. So the parents will get, what's the balance? So what's 715 minus 14.5?
700.5.
It doesn't stop there. Also, the total comprehensive income attributable to owners of parents and NCI to also be 40% times what is what's the profits? What's total comprehensive income? This 200. So 200 minus that 15 is going out times B over 12. Then you multiply by 40%.
18.5.
18.5. Then the total is 875. So what is 875 minus 18.5?
856.5.
856 point what?
856.5.
Can you confirm this 18.5 again? How did you get it, please? Let's look at it. If we do 200 minus 15 divided by 4 times 40%. Okay, yeah. 160 minus 15 divided by 4
That's
times.
18.5.
Okay, everything is perfectly correct. Okay, so I guess let's stop here for tonight. Then on Saturday,
Hello, sir.
we would finish up. Yeah,
Hello,
Mr.
sir. I think it's supposed to be 48.5, not 18.
48.5.
Yes.
Okay, how did you get that? Let's check it.
That is 200 minus 15
Mm-hmm.
multiplied by 40%.
No. You are going to prorate it first. So
Okay.
you're going to prorate to know what we are taking 40% of. So it's correct.
That's correct.
Yes. So guys, let's stop here for tonight. Then we're going to finish it up with this other question when we meet on Saturday. So just take your time and please understand what we have done so far. And by time after this one, after we solve this question, we are going to move to statement of financial position. Statement of financial, yeah, we'll start statement of financial position before we end this question. When we are done with this business combination achieved in stages, we are moving to disposal of equity interest. That also follows the same pattern as this. So you really need to understand this one very well. Then it flows into that disposal. So let's see how it goes on Saturday. Okay, do you have any questions? Because I think everybody is tired, even myself. So Michael, do you have a question?
Sir, please, what I want to ask is that please help us share this question because the last time you said if I'm in class or not, I'm trying to see if I have the question on WhatsApp. So, like you are scrolling up and down, I can just be calling it for you. So, you know, but I check. I can't find the question, sir. So, can you help us share it on WhatsApp? So, next class we can be able to flow with you, sir.
Okay, all right, that's a good idea. Okay, so I'll see you guys on Saturday where we're going to finish up on this. Thank you very much. See you. Bye.
All right, good night, sir. Thank you, sir.
Thank you.